Welcome to today's webinar. Today we're joined by Foundation Home Loans, who will tell us a little bit more about what lenders look for from a specialist finance application. But to start with that, I'm going to cover off a little bit more about the general specialist market and what we look for from a packager point of view. So first of all, very briefly, who are Crystal Specialist Finance? We have over 80 lenders on panel across our 6 business sectors, so commercial, bridging, buy-to-let, residential, secured loans and development finance. We are dedicated to the intermediary, including training, BDM visits, case management. So we believe firmly in education. We believe that by giving you the tools you need to assist your clients, we can all do more business. We are multi-award winning. As you can see there, we were extremely proud to receive the Best Specialist Distributor Award at the recent Bridging and Commercial Awards held down in London a couple of weeks ago. And as a team here, we've got over 200 years collective specialist finance experience. The senior management team have been in the business now for almost 15 years. So that we've seen many scenarios that hopefully that you'll come across with your clients. And then our plan, of course, is to help you complete more business. So our motto there, making specialist finance crystal clear. They're our passionate motto. Obviously, you trust us. We need to deliver on that. We assist you on every case. We're only as good as the last one we do. Picking a few little bits out, speed, service and flexibility really are the key that we want to take away from this. We believe we should assist you in completing more business, not make things more difficult for you. So specialist finance then, the 6 sectors that I touched on a little bit earlier. Residential for us includes things like new build, first time buyers, ex-local authority, etc. With buy-to-let, it's the more complex one. So here we're looking at HMOs, student lets, portfolios, and obviously that rise in limited company applications that we're seeing currently. Commercial, exactly what you'd expect. This could be anything from a mixed-use property through to semi-commercial, office, industrial unit, shop, literally anything with any kind of commercial usage. But it can also include things like residential above commercial. Semi-commercial way, maybe your buy-to-let landlords are looking to get a bit more involved in more high-yielding properties, or expats looking to buy investment properties in the UK. Second charges, really, really big growth area at the moment. People are on some really good first charge rates. Second charge lenders are becoming much more competitive. The rates are now dropping into the 3s. And these can be used for things like home improvements, capital raising, debt consolidation, or to raise capital, paying holiday or school fees. Certainly worth looking at for all of your remortgage clients. Bridging, again, always been a very big part of our business, basically a short-term loan, so anything for up to 12 months. But some lenders are even pushing the boundaries on that, maybe going to 24 or 36. So again, perfect for your auction purchases or where you're looking to buy below market value. And then finally there, development. With the shortage of housing stock in the UK, many people are now looking to add value to sites or to redevelop existing units. So this could be conversions, it could be developing blocks of small studio units, for example. And again, we can assist where we're looking at complicated borrowers, such as overseas clients or even trust applications. So one thing you'll notice is that the specialist market and the mainstream market are becoming much more aligned than they ever were before. So I touched briefly on the rate there for a second charge being in the 3s. We're looking now at residential rates being in the 2% mark, which is amazing considering that it's supposedly specialist lending. So what you'll see from your clients is that there's a big crossover now between the two. So where we're looking for solutions for self-employed clients or clients with multiple sources of income, clients with a little bit of adverse credit or even unusual property types. The recent changes in the market by the lenders have brought this specialist lending space. It's always been a bit of a dark art, a bit of a surprising sector, much more into the mainstream. So now using things like AVMs, using things like dual representation, it suddenly makes this a much, much more viable option. One of the biggest objections we get when we talk about specialist finance is that basically you just don't get them. As a recent survey revealed the following: 51% of brokers polled said that their cases are straightforward. And then as you'll see here, there's various other things that they said, occasionally I do come across adverse credit or I do come across self-employed clients. So what that means is nearly half of brokers polled do deal with what's called specialist finance cases. And you wouldn't necessarily look at that and think, I need to turn to a specialist lender to help these clients. Self-employed, the changing demographics of the population, meaning now that more and more lenders are looking at these REO products or residential interest only, lending into retirement. Again, expats, foreign nationals buying in the UK has always been a big area of business. Or people with multiple jobs, people with complex income situations, or even simply looking to consolidate existing debts. So hopefully you'll see something in there that you'll think, yes, that maybe I do need to be looking at specialist finance a little bit more for my clients. But what does that actually mean? So compared to mainstream rates, people think specialist rates are different. And yes, they can be a little bit more expensive. In commercial, we'll talk about rates from 2.5%, but the rates go up to 8s and 9s. In residential, we've got rates at 2.25, 2.5, but the rates go up to 13, 14, 15% dependent on your client scenario. So why do they seem scary? Because your clients don't know any different. Your clients will go on a price comparison site and see something there and think that's what's going to be available to them. So where we're concerned, the good brokers, people like yourselves that are trying to educate yourselves and listening to this, really have a big part to play here, because you know the market, they don't, so we can really help to position the clients. And what does tend to happen is the more adverse, the more complex, the more difficult the case, and the higher the interest rate becomes. It's a simple model, risk versus reward, isn't it? So the more difficult the case, the more expensive the rate's going to be. However, we're here to help you to sell these products to your clients if their circumstances bring them towards this. And again, good brokers understand that this is part of a journey. This isn't a solution for the client, this is a solution for the client today. So in 2 years' time, once the credit's improved, or once they've got a better income position, or once the property is now in a different condition, then we can look to exit this loan and we can look to move the client onto something a little bit more palatable for them. So we take an example from one of our lenders at the moment. This is what they class as an adverse credit product. There's someone with 2 CCJs in the last 2 years, someone with 2 missed mortgage payments, a discharge bankruptcy or an OVA in there. And we're talking, there you can see 2.84% on a 2-year fixed, 5-year fixed, 3.94, even up to 80% loan to value. We're talking sub 4% for a 2-year fixed. When I took my first mortgage out a few years ago now, we were talking 5s and 6s on the rate, and that was a nice first time buyer, clean credit. So these rates, yes, while they're a touch more expensive than your 1.44s that you can get from some of the high street lenders, they're not that bad, and they do reflect the position that the clients find themselves in. When we're touching on bridging, second charges, these are also excellent solutions for your clients. Maybe a remortgage or maybe a second charge isn't the right option. Good brokers look at the whole situation and look to find a solution for the clients. So if your client's looking to refurbish a property, or they're looking to sell a property before buying a new one, then bridging finance is an excellent scenario. We've helped some clients recently where they've looked to improve prior to sale. So they've took out a bridging loan, they've done a good refurbishment on the property, and they've massively increased that property value, but also increased the curb appeal as well. So it's not just about adding value, it's making your property sell when there's 10 properties on the market within your street. What's going to make someone look at yours? From a second charge, again, if you're looking for additional money for any purpose, then certainly you should be looking at a second charge option. If someone's paying sub 2, sub 3% on a first charge, then why would you look to change that to give them a more expensive overall rate? When you could just leave that in place, take a second charge, and everyone's happy. But again, these aren't the right solutions for every client. It's all about looking at the client's individual circumstances and finding that tailored solution for them. So from our point of view, it's really simple. Contact us any way you want, email, portal, telephone, come and visit us, come and see us at numerous events. We try and spread ourselves all over the place to give you the best access. Give an inquiry to our new business team. Talk through the deal. The key thing we want to do, DIP forms are great, portals are brilliant, but they can't beat a conversation. So if you can talk to one of our guys, tell them what you're looking to achieve, tell them the problems you're coming across, we'll try and find a solution for that. If and only if your client's happy with that solution, do we then take it forward to a credit search, to an application, to start instructing valuations and things like that. Up until that point, it's all just conversations. It's let's see what's available, let's see how we can help. And then from that point, dedicated case manager in-house here will process that application for you, move everything through, and then get the case completed. Where we're slightly different to others is that we also work with the solicitor for you. So we don't just get an offer and say that's it, fees are payable, job done. For us, it's about taking that right the way through to money in the bank to the client. There's never been a better time to get involved in specialist finance. There's only so long brokers can survive on things like product transfers. Purchase market's dropping, so we all need to be looking for solutions to help clients. And as clients' needs become more and more complex, as their situations become more and more unusual, then it's down to us in the industry to find solutions to those problems. The market's changing, the clients are changing, products are changing, the property types are changing, and as you've seen over the last few years, the processes from lenders, from the PRA, from the regulators are constantly changing and improving as well, which can make things very difficult, especially if you've been out of the market for a while, or maybe you haven't done a specialist finance case for a year or so. Really pick up the phone, speak to our guys, and let's get this done, let's get the solutions out there for your clients. So a quick case study for you. 67-year-old guy living in London, coming up to the end of the term on his residential interest-only mortgage. So his original plan a few years ago was to retire, downsize away from London, escape the rat race and relax. However, he changed his mind. He saw the potential to stay in business due to technological improvements that he'd made. He thought, I can have another go of this, give this 5 more years and I'm going to make a lot of money. So he wanted to remortgage, he wanted to stay in London, stay in the property. So obviously, problems, age, term. He'd been running his business down because his initial plan was to retire. So we discussed the case with the lender on panel, we looked at the merits, we looked at the opportunities there, and we worked on a bespoke 5-year interest-only mortgage, an off-plan product from this lender, but it ticked all of the boxes that the client was looking for. So it's about tailoring that solution, it's about looking at the client's scenario and saying, what can we do to help? And that's where specialist finance really adds value. So another example, a broker with a property in 5 acres of land, clean client, good income, no issues, other than slightly unusual property. And the land wasn't being used commercially, it wasn't being used for anything other than grounds, just a big garden basically. So we managed to get one of our specialist residential guys to do this at 3.59. Lender was happy with the client and the nature of the property, and we completed this with a free valuation within just 4 weeks. So thank you for listening to my quick segment on there. Now I have pleasure in handing you over to Grant from Foundation, who will talk you through the lender side of this. Thank you. Over to you, Grant.
Hello and welcome to another Foundation Home Loans webinar where we'll be breaking the myths of credit score failures. As brokers, I'm sure you can relate to situations where you've had a decision in principle declined, so you contact the lender and the response you get from them is it comes across as a computer says no. Now, assumption is often the case that the customer may have bad credit, and sometimes this might be the case, but it isn't the only reason that cases can be declined. So in this webinar, we're going to be looking at some of the reasons why mainstream misses occur in the first place. Looking at also how technology is impacting the market for the good and for the bad, and how you can actually help your clients. Now today I'm joined by our head of risk at Foundation Home Loans, Mesar Al-Ali. Mes has been with Foundation Home Loans for almost 3 years, plays a pivotal role in Foundation Home Loans with regards to our pricing, our criteria, owning the lending policy. Is responsible for the overall risk for both residential and our buy-to-let. Would you say that's fair to say?
Oh, yeah, that is fair, although the business owns the risk and we just manage it in that way.
Close enough,
yeah,
but yes,
enough,
yeah. I'm giving you more responsibility.
Absolutely.
But a pivotal part of Foundation Home Loans, and someone who I'm privileged to be working with as well, because I learn a lot from this as well. So hopefully you will get something from this webinar as well. So thank you very much for taking part in this today, Mesar. Now, if we start with technology and how credit scoring is advancing. So currently, the majority of lenders will use their chosen credit reference agency. For example, Experian, Equifax, Call Credit now coming to the market. With Foundation Home Loans, we use Equifax, and we do a soft footprint as well at decision in principle stage. But we're now seeing that some lenders are using multiple agencies to gather as much data and to ensure they don't miss anything, which is really interesting. You always had that commitment to using one credit agency before, but now you are using multiple options, which is really interesting to see that. So what we find with most lenders is simply what they want to do is they want to check, is a customer on the voters roll, how much credit they've got available to them, how much they've got outstanding, are they making their payments on a monthly basis, have they missed any payments recently, are they any CCJs? Those types of things is the basic use of why they're using that customer's credit report. And we're going to see, I think, in the future how these likes of credit agencies are actually doing more understanding of a customer's spending habits, using the likes of bank statement information, so through open banking. They'll be able to see what somebody's spending, what their appetite for spending is, and that's going to be really interesting as we see that market unfold. And I think with time as well, we're going to start seeing the likes of Facebook, Apple, Amazon coming into this space as well, and using data in a completely different way. So it excites me. I think we're at a really exciting place with regards to how we can use data more efficiently, but my fear is on the flip side of that, how lenders are using that information as well. And I think what we will also see potentially is the likes of the ability, should I say, for people to be able to produce instant mortgage offers. And I think that's very much achievable within the remortgage space. Purchase market's slightly different, but that's certainly going to be very interesting. So I think definitely watch this space. And I would definitely say this is going to be happening over the next 2 to 5 years. Mesar, have you got any thoughts at all? Is there anything that you think I've missed with regards to technology? And
No, I think it was a good overview, Grant. I think the key thing to understand is, number one, and you've touched on using new technology, and it tends to be the smaller players that are really leading a lot of these developments. And we've seen, certainly within the industry, and the credit bureau is kind of supporting that, is initiatives such as open banking, where the credit reference agencies are looking to use this technology. They partner with much smaller niche technology firms, and actually, to your point, it is the smaller lenders that have embraced that technology, mainly because they have less legacy issues than a lot of the larger banks. And that said, I think a lot of the larger banks are catching up. Certainly, Equifax have released a press statement sort of 2 or 3 months ago where they did their first mortgage offer through open banking, and that was actually with HSBC.
Right, yeah.
So there are movements actually within the larger organisations, and I think as soon as that happens, we are all going to have to go that way, because actually the market will become much more competitive.
Definitely. And I think from a foundation point of view, what's been really interesting is how we have used the likes of Castlight through open banking as well, and that's been really interesting as well, how using those tools to hopefully streamline that journey, simplify it, rather than and try and reduce some of the amount of documentation that's being sent into lenders. So, and I think accuracy is really important.
Accuracy is absolutely key.
That's excellent. Well, what we're going to do now, we're going to move into some of the myths around credit and how that's perceived. So myth number 1, there is no such thing as a credit blacklist. Is this true, Mesar?
No, it's very much false. There are things on your credit file which will probably cause a lender not to lend you. So in the most serious cases, bankruptcies, CCJs, those sorts of things. But no, there is no universal blacklist on you. Your credit file can contain so much data, and it will be up to an individual lender to then decide whether they would lend to you or not.
Cool. Okay. Myth number 2. Nobody has a single credit score, and every lender looks at credit scores differently.
That's absolutely true. I've been in the industry for nearly sort of 13 years, and where every institution I've worked at, we've had our own scorecard. We've used the same bureau data across them, but actually we will look to our individual borrowers, and certainly the sorts of customers we will look at to actually develop that algorithm. So yeah, so it is one score per lender.
Yep.
If you think of it that way.
Yeah, makes sense. Myth number 3. It's not just poor credit history that impacts the score, so does little history.
That's very, very true. If we can't decide how you perform on your credit, there's a good chance you're going to score badly on that. What you've seen in the past is certainly people that are younger, so they've just turned 18, they won't have a credit footprint. Certainly people that are new to the country, so those that have just come to the UK, for example, you will not have a credit history that will be there, and therefore you will not have a credit score that is necessarily worthy of that. The credit scores that the Bureau uses are based on the borrower base of the UK, which is around about 4 billion accounts that they tend to use. So if you have a history, you're one of those 4 billion, you're good. Otherwise, no.
Makes sense. Yeah, absolutely. Okay, brilliant. Thank you. Myth number 4. Rejection can come from fraud scoring as well as credit scoring. Is this true or false?
Definitely. I have to hasten that actually fraud indicators are up to a bank to do, and every bank does fraud differently. But yes, you could be rejected if there is suspicious activity on your credit file.
Cool. Okay. Myth number 5. Changes in circumstances can impact an application. True or false?
That's absolutely true. Less so about the credit file, more about your personal circumstances. Certainly for mortgages, if your affordability changes because you've got a new job or you've lost your job, that will affect your ability to lend. The big one on the credit file, though, is divorce. So if you have a financial associate, it's up to you to tell the Bureau that you changed your associate. Yeah, absolutely.
That's really interesting.
Absolutely.
Okay, and last myth. Your client can ask lenders why they have refused to lend.
Generally speaking, you want to protect the customer's data privacy.
Yeah.
So the key one is the lender will not necessarily give you chapter and verse about why you've been rejected. However, they may tell you that there are certain things on your credit file related to missed payments or those sorts of things. The key one is to ask your broker for an overview, and if the broker can't tell you, because the lender is protecting your data privacy, it's up to you to contact the credit reference agency, sign up to the various services that the agencies have, and actually some of the free services that are out there as well.
Yeah, that's good advice. We'll go on to the next slide now. So let's start with the issues with the voters' roll. So this is actually looking now more at mainstream misses, and where we feel that some of these mainstream misses are coming up. Now, an article that appeared in The Independent 2 years ago suggests that some 800,000 people have been lost on the electoral register. Some clients don't think it's important to register because they don't want to vote. That's often the case. Or they may have moved recently and forgot to re-register at the new address where they've moved to. And then you also get clients who have just returned to the UK, as you touched on earlier, as well, and they struggle to demonstrate their address history and may not have voted either. So even with the perfect score, you may still be declined. Mesar, how do we assess this? How would you say we look at this?
So the key one is we will try and verify identity and residency electronically wherever possible. We're no different to any other lender in that respect. However, if you don't have that, the key one is proof of address and good proof of address. So you'd want to look at where you live, produce a utility bill, a council tax return is always good. Bank statements are always good with your address on there, and obviously your own proof of identification as well. So photographic ID is key for those ones. But generally, that will allow you to go down a route where you can solve that residential history issue. Obviously, we have our own lending criteria related to how long people will need to have been resided in there in the first place. Yeah. But generally speaking, the key one is you can verify it manually.
Absolutely. I think that's one of the key parts of what's coming out, and what I've seen from speaking to brokers as well, is that, and we go back to that, one of the points I've raised earlier, is that some lenders say, well, no, if it doesn't fit, it doesn't fit, because they haven't got the time. They're working to a volume model, whereas somebody like ourselves has that ability to spend that more time looking at that individual case, and understanding that individual customer's circumstances. So I think, on the voters' roll, it's such an important thing, and you don't actually realise how many points you lose off your score by not being on the voters' roll. It's such an important part of being able to identify where you are living as a customer.
Exactly.
The next one we're going to move on to, and you touched on this one earlier as well, is ex-partners and associated credit score issues as well. So with divorce and separation on and up, this is actually one of the biggest causes of credit problems in the UK. So if your client has a joint mortgage or a bank account and they've missed a payment, this will have an impact, won't it? It will definitely have an impact. Mesar, is there any advice you would give to brokers and clients to avoid this?
They have to contact the credit reference agency in the first instance. They will provide all the advice they need. They'll provide all of the advice that you need in order to actually correct your credit file and actually remove that financial association. But the customer has to get in touch with them first. The broker should be able to provide you with the contact details of the 3 credit reference agencies. If not, speak to your bank. Your bank can also provide those details as well. But the key one is you have to do that yourself. Your bank will not do it. No. Your broker won't do it. It won't magically happen. As soon as you do that, you have to break all financial associations on your credit file.
No, I think it's really important. And a friend of mine actually had their own. They were going for a separation, and they hadn't contacted the lender. Didn't realise there was a missed payment on the mortgage until afterwards.
Correct.
And at that point, he then contacted the lender, and the lender said, "Look, you need to let us know that. We'll then, if there are any issues in the future, we will contact you separately. Give us your new address details so we have all that information. We can send you your annual statements, etc." So it is really important. You might not be able to come off the mortgage straight away, but it's important you let the lenders and your banks know where you're actually residing. That's brilliant. Thank you for that one. The next issue, the dreaded CCJ and the 6-year itch. So I'm sure we'll all agree that CCJs, whether it be satisfied or not, will impact a client's credit score. That's a fact. You're always going to have an issue if you have a CCJ registered. And it's on the increase. So much so that in 2017 there was close to 400,000 debt judgments filed. And this is an alarming figure, and I believe will continue to increase as well. Whether it be because you didn't realise you had that CCJ registered. So in some instances, you might get it for a parking fine that you think, oh, I've let that go. You didn't change the address of your car in the first place that then triggered it, but they found you and you've got a CCJ put against you. Mobile phones will give you CCJs for fun almost, it seems. So it's happening more and more. And we're now seeing more lenders coming to the market who are able to accommodate that, which is excellent. But we're also seeing that being a big cause of decline in applications, or combined with the voters' roll as an example. And that's really interesting to see. So I think from the CCJ side, I don't know if you've got anything you would add on that. I mean, is there anything specific that you look for?
I think the CCJ, once it's on there, is on there,
yeah.
And it affects your credit worthiness. I think the key thing is to understand exactly what's happening with your credit file. And we talk about, and we do see anecdotally that people are getting more CCJs and they're getting those registered, and actually they're getting registered against their business, if you like, for example. So the key one is just to regularly check your credit file. Again, there are services out there that the Bureau uses, and also there are some free products that you could use to actually manage your credit file. I think the key one is education on this point and know exactly what's going on in your credit file there.
Absolutely, yeah. No, brilliant. The next one to look at, and this is an interesting one because you think of now how people buy things in this day and age. People don't just buy things, they save up their money, they go and buy something. They want a new sofa, they want a new television, they're going to go in, they're going to get it on finance. They're going to get a car, they're going to get PCP or HP, and they're using credit more and more. So actually, the more you are searched, the more credit you're taking out, actually has an impact. Whether you can afford it or that doesn't matter, but actually the number of searches you've had carried out shows an appetite.
Absolutely, credit hungriness.
Yes,
it's called.
Yeah.
Generally speaking, it's an interesting one because this has always been a big debate, I think, within the industry, which is why a lot of the credit bureau moved towards quotation searching, or rather soft searching, that we know, particularly with the advent of price comparison sites. But generally speaking, customers that have a lot of searches where the lender can see them, so they are hard searches, they tend to be riskier.
Yeah.
So therefore you will see a lower credit score.
Absolutely.
For those customers.
And we've got a case that we'll talk about at the end that we've recently had come into us that I think is a prime example of where this would fit into the customer as a whole, without giving too much away, is absolutely fine. But they've had 7 searches, and that has had an impact on them being able to get a mortgage elsewhere. So for ourselves, that's a really good example. The number of searches that a customer has carried out has an impact on that. Next one, credit card issue and that appetite for credit. So we kind of touched on that earlier because it does link in with the searches. But if you're looking at a customer at the moment and they use credit a lot for what they do, the debt to income, sometimes it's referred to as. I mean, how do we look at this scenario, or how would you assess this?
So there's the two ways where so generally speaking, your credit utilization is again part of your overall credit quality. So those with credit card debts, particularly where you have a limit and you utilize a lot of it, they tend to be seen as high risk, obviously, because you're not necessarily living within your means, or potentially you're just overspending. Everybody likes to have a good time and go on holiday. The key thing is pay down your credit card, because one of the bits around your credit card, and actually again some of the free services and some of the credit file or credit providers out there will show you where your utilization is. That can actually have an impact on your score purely because you're not paying it down.
Got you.
The key thing around that is how we assess it is, number one, obviously we will take your overall customer quality, but our criteria is specific on missed payments. So as long as you're keeping that, okay, you might be okay from a criteria perspective. However, I would stress that you're also going to be impacted from affordability, and we, just like other lenders, will use your utilization to talk about actually what your expenditure should be. And we tend to be slightly higher on credit cards than what you would pay back, but that's the same as every other lender.
Definitely, you've got to have that element of risk in there. So that makes sense to me. And I think as well, when you look at people who have credit, and we picked up on this a couple of weeks ago as well, that customers who have access to credit, they may not even be using it, but they've still got the card available to them. So they've got a 12 grand limit on a credit card. They're not using that card, but they have potentially access to that. And then they get another credit card, and it's the ability to access that money,
Absolutely.
which is comes sometimes. So it's worth them phoning up and cancelling those cards and getting rid of those.
Correct.
So yeah, no, that's brilliant. What I'd like to do, Mesar, just before we go a little bit further, is actually to discuss one of the cases that recently came into us that, to me, was a perfect mainstream miss. The reason it was a perfect mainstream miss is it hit every one of those areas that we've just covered off. So the first thing was the fact the customer was debt consolidating. So if you look at the customer's debt to income, in this scenario, the customer had done a lot of work to her property. So she'd used credit cards, loans to put the extension in, do the kitchen, etc. She now wants to remortgage the property on that slightly higher value, but when it looks on paper, the debt to income is very high. She's actually in a difficult position there. So firstly, from us, it's that understanding of that customer's circumstances, how they've built up that credit. Is it part of a lifestyle thing, or is there means behind that? The next part of it, which was interesting, was because we touched on the 7 searches that she'd had, gave her a low score. So she had 7 searches in the last 12 months, and then on the back of that had a low score because of the credit. It was all coming together. She did have historic adverse, but it was over 2 years ago, and it was 1, 2, 3 late payments on certain things. But the last 24 months, it was actually pushing, I think, further to 30 months, where her credit was absolutely fine, which was really good to see. The client also had associated adverse through her sister who was living with her. So that then dragged into it. I don't know if that had an impact, but we do, when we touched on earlier on that association, it was something that did flag up on the report that we then had to dig a bit deeper and understand, is the sister, is she reliant on the other sister? What's the connection there? How close are they? So the case initially declined, and then we came over and presented the case to you. We got bank statements, we got pay slips for the customer, and got ourselves to a position where we were comfortable with that. Is that the type of case that you would kind of like to see more of, though, where we can? I've got to be careful how we say this, but...
Yeah, no. I think it is key that if there are... the key one is going back and understanding the customer's circumstances in more detail. You've touched on a couple of things within here which were quite interesting, because we knew that the client was debt consolidating anyway. Yeah. So from an affordability perspective, you can get a bit more comfortable with that, provided that you can demonstrate that you're able to control the fact that they are repaying those debts and consolidating them anyway. So that will change her affordability over time. Yeah. The other one is obviously your financial association. Yeah. Again, we went away and actually understood the circumstances by which she is associated to her sister, because bear in mind, you can be associated just purely from searching or taking out an account at a historic moment in time. Yeah. And certainly if they look to sort of break that association, then actually the impacts from the system will reduce over time. So I think, exactly, that is exactly the sorts of things to do. The key thing is, if you're seeing these sorts of things, that's the credit file, but you have to understand the mitigants around that. Definitely. And where possible, actually demonstrate either through documentary evidence or, in this case, through bank statements, we understand actually the customer's financial circumstances a little bit better than that. I would stress that actually the credit file itself is one part. The credit reference agencies are effectively guardians to that data, so their job is to ensure integrity of data. It's up to the lender to ensure accuracy of reporting. So actually this is exactly where we're talking about. It is just one part of the credit assessment. So.
Absolutely. No, that's brilliant. Really, really good point, Matt. And I think you've nailed that one. So thank you very much for that. So that's exactly what a mainstream miss is within foundation home loans. So brilliant. Okay, and then just the last thing that we want to cover off is how you as a broker can help your customers. So for myself, there's a few things that I think brokers should be doing before they even do a decision in principle. They should always be getting the customer's credit report. I think it's vital that when they get that credit report, they can then do the affordability, they can do a lot more accurate decisions off the back of that. So highly recommend getting the customer's credit report. And the other one for me is paying off credit that you've got available. I think it's really important if a customer shows that they haven't got any debt, but they've got access to £30,000 in credit cards, pay those off. It's that ability to access that money that can sometimes drag their score down. I don't know yourself, Mesar, if there's anything specifically that you want to highlights to the brokers at all?
No, I think you said the right thing. For me, the big thing is get a copy of the credit report, and then the three big rocks. Where does that borrower reside, and are they on the voters roll? Are they utilising their credit? And if so, can we watch for that? And again, get an idea of the missed payments and their recent arrears performance, because actually that can be the big indicator of whether or not you actually fit with more specialist lenders.
Yeah, no, absolutely right. No, I think you're absolutely spot on. Well, look, that brings us to the end of the webinar. Thank you very much for your time. Mesar, thank you for joining us as well. I do appreciate you coming in. We look forward to getting your feedback. If there's anything you want us to focus on, please let us know as well. So thank you again. Enjoy the rest of your day. Bye-bye.
If you have any questions regarding anything you've seen, or any questions regarding any specialist finance inquiries, please feel free to give our team a call, 01827 301070, and we'll be more than happy to help. All that's left for me to say is a huge thank you to Grant and Mesar for the presentation, and a big thank you to you for tuning in. Please keep your eyes peeled for the next in the series of Crystal webinars. Thank you.